Your brain hears the number $600,000 and immediately files it under not enough. Not enough to retire, not enough to relax, not enough to stop grinding. In 2024, Northwestern Mutual asked Americans how much they need to retire comfortably, and the average answer came back at $1.46 million. Charles Schwab ran the exact same exercise and got $1.8 million. Those numbers get repeated so often they've become folklore. This chart compares folklore against reality. Down here, the median American household net worth sits at $24,900. The line where you enter the top 25% starts at $600,000. Yet the target the average person believes they need towers at $1.5 million. That massive target was never built for you. It was built for the people who profit from you chasing it. $600,000 is a hard mathematical threshold where the physical laws of your money quietly but completely change direction. The gap between how that number feels and what it actually does is where people make their most expensive mistakes. Your brain compares your balance against that mythical million and concludes you're falling behind, completely missing the fact that the rules of the math have changed. To survive this threshold, the habits and instincts that actually built your wealth are going to become the exact instincts that can wreck it. Up to this point, you were the engine. The biggest force pushing your net worth forward was your paycheck, your savings rate, and your discipline at the end of the month. The portfolio itself was just a passenger. Since 1928, the American stock market has delivered a long-term real return of 7%. That is the actual growth that lands in your life after inflation eats its share. Take a look at this side-by-side comparison. 7% of a $600,000 balance means $42,000 appears in your account in an average year. Right next to it, the Bureau of Labor Statistics puts median earnings for a full-time American worker at $59,384 before taxes. Your money earns close to what a human being earns commuting and sitting in meetings 40 hours a week. Only your portfolio never sleeps, never asks for vacation, and gives itself a yearly raise. At this exact balance, the portfolio permanently stops being the passenger and becomes the primary economic engine of your household. There is a clean mathematical formula to locate exactly when this shift happens. This graph shows the crossover point. It arrives when your portfolio balance reaches roughly 14 times what you save per year. Because 7% of your total balance now equals your total savings, an average market year mathematically generates more cash than you can contribute in 12 months. If you are a high-earning household saving a massive $42,000 a year, your crossover lands exactly at that $600,000 mark. The direct link between your physical effort and your financial outcome snaps. Even the most disciplined saver can no longer outsave their own portfolio. If we look at what this money actually pays you to live on, the latest withdrawal research sets a safe rate of 3.9%. Pulling that from a $600,000 base yields roughly $23,400 annually. But the models pushing $1.5 million target conveniently forget this second income stream. You also have government-backed, inflation-adjusted Social Security. The official data puts the average retired worker benefit at $24,852 a year. Stack your portfolio with Social Security, and a single retiree has a combined base of roughly $48,800. For a married couple with two stacked benefits, the household pulls in about $62,500 a year for life. That combined income fits directly into the median expenses of a normal American retiree. It doesn't fund luxury rent in a high-cost city, but it historically covers a normal person's baseline existence without needing $1 million balance. Here is where your behavior becomes the most dangerous variable you control, because the same math that makes the gains bigger makes market losses feel absolutely lethal. The American stock market historically suffers a severe bear market, a decline of 20 to 35% every 4 to 6 years. Over a 30-year retirement, you should expect to live through 5 to 8 of them, not as a possibility, but as a schedule. Run an average 35% crash on 2 different people. The person with $60,000 invested watches $21,000 vanish on paper. It hurts, but it's the price of a used car. The person with $600,000 watches $210,000 vanish. It is the exact same percentage, on the exact same day, but $210,000 is an entire house. Human brains do not think in percentages, they think in dollars. Experiencing the physical sensation of losing a house in a spreadsheet is what makes someone who did everything right for 20 years panic and sell everything in a single afternoon. The crash itself isn't even the worst part. The largest mechanical threat to a $600,000 portfolio is a mechanism called sequence of returns risk. This chart demonstrates how the risk triggers. If you sell shares to fund your living expenses at the very bottom of a market drop, those shares are permanently eliminated from the recovery. The math doesn't bounce back because the base has been destroyed. This fear produces the first behavioral trap, panic protecting. You look at the balance dropping, feel a knot in your stomach, and move your money into safe, low-yield cash. It stops the emotional pain today, but you quietly sacrifice the most productive, compounding years of your life to pay for that safety. The mirror image trap works in the opposite direction, coasting. The number finally feels big enough to relax, so you soften your savings rate to buy a nicer car or fund a renovation, right at the exact moment the compounding curve starts bending upward the hardest. Both of these traps share the exact same root cause. The dollar amount finally became real. Fear or comfort took the wheel, and the math got demoted to an advisory role. Everything you did before this line rewarded effort. You earned more, you optimized, you pushed. But above $600,000, your physical effort becomes statistically irrelevant to the outcome. The highest leverage, most profitable action available to you now is absolute restraint. Holding through a drawdown, looking at the damage, and choosing to do absolutely nothing out-earns a year of overtime. The person who builds a $600,000 net worth and the person who keeps it are entirely different entities. Building it took aggression. Keeping it takes passivity, patience, and a total refusal to be helpful. To survive the crossover, you have to fire the builder and hire the protector.